Baker investment students, this is our final week. Just want to say I've enjoyed working with you all this past 7 weeks. This week we wrap up with chapter 14 and 15, so read those chapters. We also have a very brief forum discussion, and the final exam will be out there. It's a 50-question test. I'm going to release it this weekend. I'll give you all week to work on it. So it'll be 2 points each for a total of 100 points. And again, just make sure you get everything submitted by next Sunday before midnight, and you should be good. With the chapters we work with this week, chapter 14, you're looking at options. With these chapters, with options and futures, most of us would probably never engage in any types of options or futures trades. Not saying we couldn't someday to try to protect our portfolio. Maybe you're in retirement, you're worried about losing a lot on your portfolio. You might go to a broker to try to protect it in some way, but there's probably alternative methods that you can use. But it's for us to really understand, maybe how the big players, whether it's insurance companies, businesses, or investors that manage our 401ks, might use these derivatives to help protect our assets. Again, with options and futures, a lot of people use these to hedge, that is, to protect some underlying asset. As I did my Otis trades this week, I made a big bet on gold, and later in the week it really cost me. So I was just speculating. I didn't have any gold to protect, and maybe next week it will be back up. So we'll see what happens. But with that, using derivatives, that is options and futures, derivatives mean they derive their value from some other underlying asset. And it's highly risky if you're just speculating with them. So most investors use them as a hedging tool. So getting back to options, with options, you basically have to have someone that's willing to write the options. They're almost like an insurance company. They know that they're going to write a certain amount of options, and on some of those options they're going to have to pay out on. Just like an insurance company writes many premiums, and if there's a car accident, they have to pay out on that. But they're hoping that most of them, they don't have to pay out on it. So that's how they make their money. But investors may buy them to hedge against something. You give them, have a put is the right to sell it, maybe a stock at a certain price, or a call right to buy. And there's kind of a strike point that has to be hit, like a strike price before the money, what they call in the money, and you value these options. And then you have to take in consideration also that you have to pay for these options. So there's almost like a break-even point before there's any profit that can be made. Okay, with the futures contract, futures are another way that someone could hedge. If you're a farmer and you're worried about the price of wheat going down in the future, you may take a position in a futures contract to go short. That means that you're betting that the price doesn't drop. So if 6 months from now the price of corn does go down, when you go to the market you're going to lose because you sell the corn at a lower price. But because you have this futures contract over here, you bet it was going to go down, and then because it did, you're going to win on the futures contract. So it's really just an offset. And you could also look at it from a perspective of someone buying the wheat in the market. They would do an opposite transaction. But again, futures contracts, you can put up just a little bit of money, what's called a margin account. You have to have a margin deposit. And as long as it moves in your favor, they'll add money to the account. But if it moves out of your favor, they'll take money out of the account. And if it hits a certain threshold, they'll have a margin call. You have to add money into the account. Almost with all futures contracts, usually most people close out the position. So that you don't actually want 50,000 cattle delivered to your doorstep. So it's just you do the opposite transaction to close it out. But it's an investment tool, and it's a complicated tool. But it's in this chapters they had explained some of the basics and help you understand some of the models and theories, and even trading techniques. And with that, just understand again that these are derivatives, and we do need these in the market. There's been some debate in the years about whether there should be more regulation in futures, and I'm one to believe that that market, the option, the futures, helps provide liquidity to the markets. Probably you don't want too much regulation, even though we did have a lot of bad things happen after the subprime crisis with credit default swaps, which was a different type of derivative. But options and futures markets have very regulated markets, and with those futures, again, You can just put a very small amount on a very large contract, and just penny changes can result in big dollar changes in the value of that contract. Okay, well, that's it for this week. Again, I want to say I've enjoyed working with you all, but do send me an email if you have any questions. But have a great week, and we'll wrap it up by next Sunday. Take care.